Gary has 11 days to sign one piece of paper that he can never undo. On one side of that paper is a number, $280,000, sitting in his hands today. On the other side is a promise, $1,500 a month for the rest of his life, no matter how long that life turns out to be. He's 60 years old. His wife Diane is 59. And somewhere between these two options is a mathematical trap that has quietly wiped out the retirements of thousands of Americans who thought they were being smart with their money. Most of them chose wrong, not because they were careless, but because nobody ever showed them the formula hiding underneath the decision. By the end of this video, you are going to know exactly what that formula is, and you are going to understand it better than most financial advisors ever bother to explain it, because I'm going to show you the one number that determines whether a lump sum turns into freedom or turns into fear. But first you need to understand why this decision even exists in the first place, and why it is disappearing for almost everyone in America right now. Before I show you what actually happened when Gary opened that envelope, hit subscribe right now, because on this channel I dig into exactly these kinds of real financial decisions, the kind they don't teach you in school and your bank definitely will not explain to you in 5 minutes at the counter. I'm David Marshall, and this is not a video about theory, this is a video about the actual formula. And by the time we get to the end, I'm going to show you two strategies most people never even hear about. One of them so simple it feels almost like cheating the system legally. Here's the part that surprised me the first time I dug into the numbers. Pensions are not just becoming rare, they are becoming extinct, and there is a very specific financial reason why. A traditional pension, the kind that pays Gary that guaranteed $1,500 a month, costs a company roughly 20% of that employee's salary every single year just to fund it. Compare that to the simple 401k, the kind most of us have now, where the average employer match costs the company somewhere around 3%. 20% versus 3%. That is not a small gap, that is the entire reason your parents might have had a pension and you probably do not. Companies did the math and they walked away from the promise. Which means if you or someone you love is one of the shrinking number of Americans who still has access to a real pension, what you do with that decision matters enormously, because you are holding something that almost nobody gets to hold anymore. And that decision does not happen in a vacuum. It happens inside what I call the retirement red zone, the 5 years right before you retire and the 5 years right after, 10 years total, sitting right in the middle of your financial life, and it is the single most dangerous stretch of time you will ever navigate with your money. Here's why. The decisions you make in the retirement red zone can impact your security for decades, not years, decades, because this is the window where a single bad year in the stock market does not just dent your savings, it can permanently cripple them in a way that even a strong recovery afterward cannot fix. There's a term for this, and once you understand it, you will never look at a lump sum offer the same way again. It's called sequence of returns risk, and it is probably the most dangerous phrase in all of personal finance that almost nobody has heard of. Let's go back to Gary and Diane sitting at their kitchen table with that $280,000 number in front of them. Option 1 on the table is simple. Take the lump sum, all $280,000, and invest it. Total control, total flexibility. If the market does well, that money could grow into something much bigger than any monthly pension check would ever pay out. It sounds like the obvious choice, right? Except here is what almost nobody explains to people sitting in Gary's chair. If Gary drops that entire lump sum into something like the S&P 500 and starts pulling money out every month to pay his bills, and the market drops 30% in year 1 or year 2 of his retirement, he is not just down 30% on paper, he is forced to sell shares at that lower price just to eat, just to pay the mortgage, just to live. Every share he sells during that crash is a share that can never recover for him. He has locked in the loss permanently. Meanwhile, the guaranteed pension check does not care what the S&P 500 did last Tuesday. It shows up every single month, rain or shine, crash or boom. So let me show you something that changed the way I think about this entire decision, and I want you to really picture this. Imagine two versions of Gary walking out of that retirement meeting on the exact same day. In the first timeline, Gary takes the full $280,000 lump sum and rolls it straight into the market. 18 months later, the market drops 30%, a completely normal, historically ordinary crash. Gary still needs roughly $1,400 a month to live, so he keeps selling shares to cover it month after month straight through the bottom of that crash. By the time the market fully recovers 3 years later, Gary's account has not recovered with it. He sold too many shares too low and the math never lets him catch back up. 10 years into retirement, this version of Gary is watching his balance shrink toward zero, doing the terrifying math on how many years of Social Security checks he has left before the rest runs out. Now picture the second timeline. This version of Gary took the guaranteed monthly pension instead. The same 30% crash happens. The exact same headlines flash across his television. And his check still arrives, $1,200 or $1,500, whatever his option was, completely unaffected by what the market did that year. He does not sell a single share because there is nothing to sell. He just lives his life while the first version of Gary is quietly panicking. That difference right there between the version of Gary who got crushed and the version who never even noticed the crash, that is sequence of returns risk in its purest form, and it is exactly why you cannot replicate a guaranteed pension using market-based stocks. You can chase a higher average return in the market, but you cannot chase away the risk of bad timing, and bad timing inside the retirement red zone is what actually destroys retirements, not bad investing. Now here's a question you're probably already asking. If Gary's pension is just a promise from his old employer, what happens if that company gets into trouble or worse, goes under completely? This is where most people's stomachs drop a little, and it's a fair thing to worry about, because a pension really only exists because of what I call company promise solvency, meaning that promise is only as strong as the company standing behind it. But there is a safety net most people do not know exists. It's called the PBGC, the Pension Benefit Guaranty Corporation, a federal agency that exists specifically to insure private pension plans when a company fails. As of 2025, the PBGC guarantees single-employer pension plans up to $7,431.82 a month for someone retiring at 65. Let that number sit with you for a second. That is a level of protection you simply cannot buy in the stock market at any price. And it is one more reason why study after study shows that guaranteed income sources cut retirement anxiety in a way that a fluctuating account balance never can. But knowing your pension is protected does not answer the actual question sitting on Gary and Diane's kitchen table, because a guaranteed check is only half the puzzle. The real complexity, the part that trips up almost every couple in this exact situation, is what happens to that check when one of them is no longer around to receive it. And this is where the real decision begins. When Gary sits down with his plan administrator, he does not just get one number, he gets three, and each one tells a completely different story about what happens to Diane if Gary passes away first. Option A is called the single life pension. This pays Gary $1,500 a month, the highest check of the three, but there's a catch buried in the name itself, single life. The moment Gary passes away, that check stops completely the very next month, and Diane is left with nothing coming in from this particular pension at all. Option B falls under what's called a joint life pension, and this specific version is the 100% joint survivor pension. This one pays less while Gary is alive, $1,200 a month instead of $1,500, a 20% cut right off the top. But if Gary passes away first, Diane keeps receiving the full $1,200 a month for the rest of her life, no reduction at all. Then there's option C, the 50% survivor pension. Another version of that same joint life pension structure, sitting right in the middle at $1,310 a month while Gary is alive. But if he passes first, Diane's check drops down to half of that. Three options, three completely different bets on how long Gary lives, how long Diane lives, and how much risk this family is willing to carry. Most people just eyeball these three numbers and pick whichever one feels safest emotionally in the moment. And that right there is usually the most expensive mistake in the entire pension decision, because there is a mathematical move sitting inside these three numbers that almost nobody uses, and it can hand you the highest monthly check available while still fully protecting your spouse. I want to show you exactly how that works right now. Here is the pension arbitrage formula, and once you see it, you cannot unsee it. Gary takes option A, the single life pension, the highest check on the table, $1,500 a month. Everyone in the room gasps a little at this point, because it looks like Gary just chose to leave Diane with nothing if he dies first. But watch what happens next. The difference between option A at $1,500 and option B at $1,200 is exactly $300 a month, or $3,600 a year. Gary takes that $300 difference and uses it to buy a simple, cheap term life insurance policy. Not a complicated, expensive whole life policy, a plain 10 to 15-year term policy, the kind you can get through a company like Ethos, and for a healthy 60-year-old, $100,000 of coverage might run him around $100 a month. So here's the arbitrage. Gary is now spending $100 a month on that term policy, out of the $300 difference he gained by choosing the higher single life check. That leaves $200 a month, or $2,400 a year, sitting in his pocket that he would not have had under the joint survivor option. But here's the real magic. If Gary passes away during that 10 to 15-year term, Diane does not just lose the pension check like she would have under Option A alone. She receives $100,000 completely tax-free in a single lump sum from the life insurance payout. That is often more protection than the 20% joint survivor penalty would have ever given her, and Gary got to enjoy a higher monthly check every single month he was alive to spend it. This is the pension arbitrage formula. You take the highest check, you hedge the risk with a term life insurance hedge, and you come out ahead on both sides of the bet. Now that formula works beautifully if Gary and Diane decide to take the monthly pension route. But remember, they still have that other $280,000 lump sum sitting on the table as an entirely separate choice. And if part of you is still drawn to that lump sum, because of the flexibility, because of the growth potential, because you don't love the idea of locking yourself into one company's monthly check forever, I understand that instinct completely. So let me show you the second strategy, the one built specifically for people who want the growth of the market without walking straight into the sequence of returns risk we talked about earlier. I call this one the private pension hybrid plan, and it might be the single smartest move available to anyone holding a large lump sum decision like this one. Here's how it works. Instead of taking that $280,000 as a check and paying an enormous immediate tax bill on it, Gary rolls the entire amount into an IRA. This is called a pre-tax rollover, and it is what keeps the IRS from treating this as one massive chunk of taxable income in a single year, the kind of mistake that can push you into a brutal tax bracket overnight, what I call an ordinary income squeeze. Once that money is safely inside the IRA, here's where the real strategy begins. Gary splits it 50-50. The first half, $140,000, goes into a private annuity purchased through a company like New York Life. This creates Gary's own personal, private version of a pension, a guaranteed baseline income he cannot outlive, functioning almost exactly like the defined benefit payout he would have gotten from his old employer, except this one Gary built himself. The second half, the other $140,000, gets invested into a diversified growth stock index, something tracking the S&P 500, giving Gary real exposure to market growth for the next 20 or 30 years of his life. And here is why splitting the money this way quietly solves the exact problem that destroyed the first version of Gary in our earlier story. Gary's guaranteed baseline expenses, his mortgage, his groceries, his utilities, are now covered by the private annuity check month after month, completely independent of what the stock market is doing. Which means when a crash does eventually happen, and at some point over a 20 or 30-year retirement it always does, Gary does not have to touch his growth portfolio to survive. He does not have to sell a single share of that S&P 500 index at the bottom of a crash, because he is not relying on it to pay this month's bills. He can simply let that half of the money sit through the storm and recover naturally, the same way it always has historically. This is the entire secret behind safe portfolio withdrawal rates. The idea that how much you can safely pull from an investment account every year depends enormously on whether you're forced to sell during a downturn or whether you have the freedom to wait it out. Gary just bought himself that freedom for half the cost of doing it entirely with market money. And once again, the decisions you make in the retirement red zone are what determine whether that freedom exists at all. One more piece worth knowing here, especially if you're looking at a pension decision before the traditional retirement age. If Gary needed to access money from that IRA before he turned 59 and a half, there is a lesser-known IRS provision called the 72T strategy, which allows someone to take substantially equal periodic payments from a pre-tax account without triggering the usual 10% early withdrawal penalty. It is not the right move for everyone, and the payment schedule locks you in for a set number of years, but it is one more tool sitting quietly in the toolbox for anyone who needs earlier access to this kind of money. Now here's something interesting about human psychology that shows up in almost every version of this decision I have ever seen. Researchers call it income certainty bias, and it explains why so many people instinctively reach for the guaranteed monthly check even when the math might favor the lump sum, or reach for the lump sum even when the guaranteed check would actually serve them better emotionally. We are wired to overvalue certainty, sometimes even when it costs us money, and once you can name that bias in yourself, you can finally make this decision with your eyes open instead of your fear driving the wheel. And I'll say this plainly, every family's numbers are different, so before you sign anything, run your specific numbers with a fee-only advisor or a CPA who has no product to sell you, but now you understand the exact formula they should be working from. If any part of this sounds like your own situation, here's where to actually start. Call your plan administrator and ask for what's called a pension estimate letter, showing all of your specific payout options side by side exactly the way Gary saw his three numbers. Then get actual term life insurance quotes based on your real age and health, not the rough estimate I used for Gary, because your number could be higher or lower depending entirely on your own medical history. And if you're leaning toward the lump sum path, get a few annuity quotes from more than one carrier before committing your money anywhere, because those rates shift with interest rates and can vary meaningfully from company to company. None of this takes more than a handful of phone calls, and those phone calls are often worth more than years of guessing. So what did Gary and Diane actually decide, sitting at that kitchen table with 11 days left on the clock? They looked at their full financial picture, their social security timing, their health, their extended family history, and they chose a blend of both strategies. They took the monthly pension using the pension arbitrage formula, the higher single life check paired with the term life insurance hedge, because it gave them more guaranteed monthly cash flow while still fully protecting Diane. Then because Gary also had a smaller retirement account sitting separately from the specific pension decision, he applied the same private pension hybrid plan thinking to that account too, splitting it between guaranteed income and market growth. 9 months after signing that paperwork, the market actually did drop, not 30%, but a sharp, uncomfortable 11% correction that had plenty of Gary's old coworkers panicking and checking their accounts every single day. Gary did not check his account every day. He did not have to. His guaranteed checks kept arriving exactly on schedule, and the portion of his money sitting in the market simply had time to breathe. And that word breathe is exactly where I want to end this video, because it brings me to something I come back to on every single video on this channel. I call it the oxygen philosophy, and it is the single most important idea I can leave you with today. Think about oxygen for a second. You do not think about it when you have it. You do not wake up every morning grateful for the air filling your lungs. You do not track it. You do not celebrate it. It is simply there, invisible, silent, until the one moment it is not, and in that single moment nothing else in your life matters more. Guaranteed income works exactly the same way in retirement. Nobody throws a party because their pension check or their annuity payment showed up on the first of the month. It just arrives quietly, invisibly, the same way oxygen fills a room. But take it away during a market crash, during a health scare, during the exact wrong 10 years of your life we call the retirement red zone, and suddenly it is the only thing you can think about. The goal of retirement was never to have the single highest possible number sitting in an account somewhere. The goal is to make sure you can always breathe, no matter what the market, your health, or your circumstances decide to throw at you in a given year. That is why guaranteed income, protected the smart way, arbitrage the smart way, split and hedge the smart way is not boring, it is oxygen, and once you build enough of it into your plan, you get to spend the rest of your retirement actually living instead of constantly checking the balance just to see if you can still breathe. Study after study shows that guaranteed income sources cut retirement anxiety, and now you know exactly why and exactly how to build it for yourself. If this video helped you see your own retirement decisions a little more clearly, make sure you're subscribed, because every week I break down exactly this kind of real financial decision, the ones with real numbers, real trade-offs, and real formulas most people never get shown. I'll see you in the next one.